This lesson is going to cover data analysis of open interest. So what is open interest? In crypto, futures markets make up the majority of the volume. And futures markets are where you can long or short a derivative of Bitcoin or any altcoin, and the result is known as a contract. So you want to think of the futures like a handshake agreement to bet on the price of Bitcoin rather than swapping real Bitcoin between each other, which would be the spot market. Open interest only deals with the futures market. Why does this matter? Because the futures markets, as I said before, have the majority of the volume. The reason they have the majority of the volume is because they allow leverage. So you can take $10 and hypothetically turn it into $1,000 by using crazy 100x leverage. Yeah? That allows an almost infinite number of Bitcoin to be traded. There's no 21 million cap if you're trading derivative contracts. And so because of that leverage, because of that ability to bet more than you actually own, the leverage can create volatility and it can create liquidations, which offers trade opportunities for us. So, open interest is an indicator that simply tells you the number of open contracts in a particular market, hence the name. What this means is, when a buyer and a seller reach an agreement, a contract is made and it gets recorded in the OI total. The contract will remain on the total until the position is closed or liquidated. In the meantime, the buyer and seller can do whatever they wish with the contract. The guy who went long can close part of it. The guy who went short can close part of it. But regardless of any actions, the contract remains recorded until it is fully closed. It has to be fully closed to be removed. Now, it's important to not mix it up with volume. Right? You might think, what's the difference between open interest and volume? Open interest, if it's rising, shows you and tells you that new money is being pumped into the market. But if open interest is declining, it actually shows that money is leaving the market. That's the big difference between volume and OI. Every single transaction that's made during a time frame will make the total volume rise. It doesn't matter if you're opening a position or closing a position. Volume is volume. It just goes up. Volume cannot do anything but go up in a fixed time period. Whereas open interest only tracks the opening and closing, and as such can rise and fall, because the number of open contracts can go up and it can also go down. Volume is time specific and open interest is not. That's another important one. Meaning that you have to set a time to measure volume, right? If you say how much volume was there, I would say in what time frame? You'd say, okay, how much volume was there in a day? And I would say, okay, there was 1 billion of volume on Bitcoin in a day, in 24 hours. The same doesn't apply for open interest. If I open a new trade today, it does not matter what happens at the end of the day. It remains as an open trade on the open interest indicator until I close that trade. That could be a day, a week, a month, a year. Now, sometimes it's confusing here about open interest. A common question I get is, if I buy 1 Bitcoin and then someone sells it to me, so if I go long and someone else goes short, doesn't that mean that open interest goes up by 2? The answer is no. The open interest can only go up by 1. It goes up by 1 though for every new contract. So don't think about it as individual people buying from each other, because that doesn't happen in reality. There is never going to be a case where you go to an exchange and you place an order and that the entire order at that exact moment comes from somebody else, right? So you want to think of it as each individual trade on the exchange. Very simple way to conceptualize this for you. You know, on a futures exchange, you have a positions tab, yeah, that shows you all the positions that you're in, all the longs, all the shorts. Okay. When you open a position, it goes into the positions tab. That increases the open interest by however much you open your position for, okay? As soon as that positions tab is empty, as soon as that position is closed, the open interest goes down. And that's the same for every trader all throughout the world. So that's all that matters. All that matters is the individual trader, he opens a 5 Bitcoin position. What matters is when does he close that 5 Bitcoin position? When he does, it will drop by 5. So, simple rules of thumb here. If there's a long opening and a short opening at the same time, the open interest will increase. If there's a long closing but a short opening at the same time, the OI will be neutral because I've added, someone else has taken away. And if there's a long closing, if I close, and a short closes, someone else closes, the open interest will go down. Open interest is equal to the money flowing in and out of a market. That's why it's such a valuable tool and can be very, very useful as a trader, because it actually shows you, is more money coming in or going out? Whereas volume, like I said, has great uses for other things, but volume can't tell you, are people staying in the market or not? Generally, if people stay in a market, it will continue in whatever trend it's going. If the market's going up and open interest keeps going up, the market will keep going up because people are still interested in that current trend, right? Now, let's visualize this a little more. Let's say Pepe here opens a long position on Bitcoin for 5 contracts. That would make the open interest increase by 5. Then Bobo opens a new short position of 3 contracts on Bitcoin. The open interest would increase again by 3. Then Apu opens a short position on BTC for 3 contracts and a long position on BTC for 5 contracts, which would increase open interest by another 8 for his 3 long and his 3 short and his 5 long. So that would be a total increase between all 3 of them of 16 contracts. Does not matter whether you go long or short. You have 5 contracts long, 3 contracts short, and another 8 contracts, both long and short, makes total increase of 16 contracts. Okay, let's fast forward to the next day. Pepe decides to close his Bitcoin long position, which will reduce the open interest by 5. Bobo gets liquidated on his short position of 3 contracts, and as a result, the total change in open interest is -8 for that day, and the overall level drops back to 8. So the day before, when they all opened their position, we had 16. Pepe closes his. Bobo gets liquidated. We're now back to 8 because a 5 and a 3 closed. Simple. And so because it shows the amount of new money flowing in, open interest can help us understand the strength of the market during certain moves. It can also signal when trends are losing momentum. And how do we spot this? That's the big thing. How do we know when a trend's losing momentum? Well, by using OI, we do this again with our law of harmony and divergence, right? So let's look at it for 2 examples. Here we have, and again, it's coinalize.net, completely free to access, gives you open interest data. This is the aggregated open interest, so all Bitcoin contracts, all the futures contracts that are for Bitcoin. And this is the Bitcoin price, of course. And you can see harmony. Harmony is a downtrend and declining open interest. That's harmony. Price going the same way as open interest. Compare and contrast that with this part that I've plucked out, where price goes down, but open interest actually rises. That is where we see a divergence. And much like any of your other tools or analysis methods, you want to combine that with some price action principle to then take a high probability trade. For example, if price was going down and open interest was rising, you could say that new shorts have been entering. Because as the price goes down, people weren't exiting the market, they were actually entering. And if people tend to enter following the trend, which they do, then if the trend was down and the open interest kept rising, then possibly these people who are entering are going short. As in, there's always, of course, a long and a short for every contract, but the aggression, the new people entering, have a directional short bias. Would you take a trade based on that? No, not until other factors give you confluence for that. So for example, you see a bullish move in the market. Now there is a potential bullish move here. We came down, take out liquidity, and we're back above. So depending on your particular method, you could say this market no longer looks to be downtrending. It appears to be going sideways or possibly even in an uptrend. So you could hypothesize that the market is potentially wrong. The market participants are potentially wrong. They're ignoring price, which seems to be increasing, and they're adding more and more contracts even as we're in an overall decline. So if it were to continue up, and if you were to see a strong move to the upside and you got some confirmation that would normally give you a long signal, you could enter knowing that there are probably some shorts here who are going to get squeezed. And that could give me confidence for my long trade. But similarly, if price moves the other direction, which is why you don't act on open interest right away, if price moves the other way and it starts to break down below this wonky trend line and starts to move downwards, you could say the price is continuing to go down. Open interest, you would watch and see what it has done. Has it risen or is it starting to drop? And it would give you an indication of possibly this was a bunch of new longs entering, and in fact price is not agreeing with them. So again, divergence. You have a divergence. It's not enough to tell you which side of the market to enter on, but when you get the next move, you will have more information and be better equipped to take a trade, because you know that there is some type of divergence. So you know somebody is wrong. You do not want to guess which side are wrong, but you know someone is wrong here because they're not in harmony. And so that's when you use your other factors, enter high probability trades. You can stack this along with an indicator like CVD. And if you stack open interest with CVD, you can find out who was doing the aggressive buying and selling on futures and how was the corresponding open interest changed. That can be one way. In the next lesson, I'll break down all the different types of open interest. So not just the aggregated, but breaking down into individual sections, how to use them, and some more trading strategies based on OI analysis.